Welcome in Sanjay Parekh. He's founder and CIO at Sohum Asset Managers, who's here to Top Markets. Sanjay, great to have you back on the program. Thank you very much for your time. We're usually chatting in the afternoon, so good to see you in the morning for a change. Just a quick word, Sanjay, on the markets themselves, because it seemed like, at least, that many a theme, especially defense, as we were just highlighting, right? I mean, these are themes where people have stayed long for a while, made a lot of money. But once momentum breaks, then it's kind of hard to stay long, because then you start to wonder whether I should lock in the profits that I have, or and then let's see later, where does it want to settle? Are we entering that kind of a phase in a few sectors, especially areas like defense, Sanjay?
Yeah, Prashant, absolutely right. I mean, good morning to all of you. So, yeah, clearly these are area of frauds and valuations. The flows from direct retail or certain passive funds dedicated to these sectors also has, because these are passive dedicated sectoral funds, right? So they have to buy in as they get subscription. And that is, of course, the direct participation in this such capital raise has caused froth in certain sectors, and certainly one should book profits. I totally agree with you.
So book some profits, okay. Hi, Sanjay, great to have you on. So let's explore that in some more detail. Now, where would you look at trimming positions or booking some of the profits? How are you looking at any portfolio readjustments at this point in time? Give us some more color on it.
Yeah, so Surabhi, good morning. So, our approach is we predominantly large cap. Our average large cap holding has been 80%. We always said at least 70% would be large cap. And I mean, even in large cap, we are at fair value plus. So our approach is be very, very selective. There are ideas very clearly across the board, but the filtering has to be very, very hard. So the main filtering criteria is valuations, right? So while there are opportunities, every month you get opportunities, but there are few now. And that's our approach, that be selective, have aggressive filtering criteria. We think larger caps are overvalued, they're going faster, but 3 to 5% lower, they'll get reasonable and maybe some time correction. So we're not so perturbed with large caps. I mean, 3 to 5% or even a little more is fine, and some more time correction. But in mid and small cap, there are pockets of froth. I'm not saying all of them are frothy, but certainly there are pockets of froth, defense being one. Some of the themes in railways are also going berserk. At 60, 70, 80 times, I don't know whether there's money to be made, So, and we know the euphoria on the flow side, So that is also where we are worried, and we are clearly going to stay away from such segment. And selectively, as I said, in large cap, mid cap, small cap, you do get opportunities. And that's what we are looking out for.
All right. Hi, Sanjay. Good to see you in this morning. And you mentioned in the past, I think L&T is something that you like. You prefer them in comparison to the other names that are trading at very elevated valuations. Coming back to you, Sanjay, and I wanted your thoughts on Ola Electric, but I wanted to focus on the stock of the morning, actually, Masscon. We are talking about that stock being lower. Just pull up the intraday chart. The intraday chart will tell you from the lows of the day, in a matter of minutes, the stock is up close to around 8% or thereabouts. At some point of time, the director will put that up for our viewers on the screen as well. But Sanjay, what about Ola Electric? At IPO price, people were debating. Well, the stock has almost doubled.
No, it's surprised. To be very honest, we've not participated, but there were few colleagues who were positive and they participated in funds also. And definitely, such a big move, you certainly have to introspect, right? So we've not participated. Having said that, there are comparisons you saw yesterday with Hero versus Ola, and those needs to be kept in mind, Some companies are made in 50 years, and some of these new generation companies, they speed up so fast, and execution is certainly important. Having said that, we certainly not undermining the strength of this new generation companies. They're phenomenal companies with great products, great pipeline. and definitely very, very positive, but just that valuation is discomforting, at least not in our style of growth at reasonable price.
Okay, all right. So you're choosing to give that a miss, but what would you rather play? Because you like the theme. The EV theme is something that's definitely going to take shape in the next few years. By 2030, various estimates suggest that there'll be a far larger, exposure to EVs. So in that context, Ola valuations, well, debatable out there. But
Yeah.
what else do you like then from the auto
Yeah,
space?
so, we're very positive on ancillaries which are catering to this or transiting them. We have two of them, one of them transiting towards that segment, Sansera, and even some Samel, Samadhan Motherson, certainly is very, very well poised when the EV segment takes off because it's actually agnostic, all the products that it has. So we very well poised on that side, I mean, as it takes off. And then overall renewable also, we are on the power space, we are there. On the EPC space, we have Solar Wilson. So we like the theme and we have participated, but we would want to participate in a stocks where they are reasonable price and reasonably valued at our end.
Hey, Nigel, just to go back to the shipbuilders, we've got to fire those stocks up
Massive
because
move.
the classic bull versus bear playing out on a Mazagon Dock, on a Cochin shipyard, on a Garden Reach right now. These stocks open slightly lower. Let's get the stocks up on the screen if we can. They opened slightly lower. Yesterday, the declines were as much as 9% on some of the stocks. And today, the start was lower and the dip is getting bought. We're going to be in conversation with the management of Mazagon Dock in about 15 minutes from now. The contention in a report that was put out yesterday, it was a report by ICICI Securities, and it caused a flutter because their target prices are substantially lower, 50, 60, 70% lower from where the stocks are trading at right now. Now, the contention in that report was that for a company like Mazagon, for instance, the best of the revenue recognition will play out over the next 2 years. And after that, margins and EPS, it'll all sort of, peter out and it'll become very range bound. And therefore, ICICI Securities felt that the valuations are simply not justified. Classic bull versus bear. And, right now the bulls are snapping up that stock. Oh, yes, we'll ask the chairman and managing director about the business. Of course, he's not going to talk about the stock and the valuations, but the business, really. Can the growth momentum continue? That's coming up at about 9:50. But, Sanjay, weigh in on this debate. I mean, whether it is some of these shipbuilders or some of these other, for instance, look at a stock like GE T&D today. There's some reorganization by the global parent. They might be selling some stake and, simplifying their holding structure. That stock's on down circuit right now. But again, I mean, whether it's shipbuilders, whether it's these MNC capital goods plays, they're fetching top dollar in terms of valuation. Where do you think it still makes sense to hold, if not buy fresh?
I think, the government, which is the largest owner of this, should provide the supply. I think, they understand the valuation. We saw the whole PSU basket at 13, 14 lakh crore. Today it's 65 lakh crore. So I think government should suffice this demand or euphoria by providing supply. That would be a very good thing because it will mean monetization by the government and then giving the supply where there is hunger, either through passive funds or through direct. And that, I think, is a very, very smart strategy that government should do of providing supply in all the stocks, because the valuations are really good for them to monetize. And that should be, at least, I think, because, as I told you, right, 60, 70, 80 times just doesn't fit in our strategy. We would not be participating, and that's our approach. But government clearly can monetize.
All right, interesting. Yeah, I mean, could make sense for the government to take some money off the table. But talking about government taking money off the table, they didn't do it. Vedanta, a stock I think that you've been fairly positive on, and the promoter's been making the right moves. They went ahead and they took some money off the table in Hindustan Zinc. What's the view on that one? Because, this one has been a very, very dicey one and tricky to play with the promoter, mostly not making moves in a linear manner. But now the street is quite excited. Your view?
Yeah, Nigel, so you all have covered it so well, and I think they're making all the right moves. We luckily got it way early. And then we participated even a little lower than current price as well. I think here the worry was the parent's leverage at 6 billion was discomforting. And, the promoter is consistently doing the right things. And I'm very, very confident that, they will get it to $4.5 billion of debt as a first milepost. And once they reach there, then, the risk significantly reduced, which was a hangover for the stock. And then, the business, we always, in terms of their execution, the way they run the business is absolutely impeccable. And then it will be towards this business. And the HZL monetization, I think, is a very smart move because, HZL, we pay the dividends to Vedanta, and Vedanta in turn should effectively pay 13 rupees. They've already paid, I think, 15 rupees. So 28 rupees dividend in the last 6 months you got, which at least we were looking yesterday, it's 9% on our cost as a yield. So, and then you also getting growth. So I still feel that it is undervalued. The promoter has to make the right moves towards creating value, which it is doing.
Sanjay, this is not about what you own, but what you don't own. And correct me if I'm wrong, you don't have exposure to insurance as a space. That's cited
Yes.
by a few investors as a combination at this stage of the market where there is some valuation comfort and there is growth visibility as well. Not very high growth, but there is growth. And the other is healthcare. I think pharma, etc. I think you don't have any exposure.
Yes.
Of course, you can't own everything, but I just wanted your thoughts on these two areas.
Yes, so we have Sun Pharma and Aurobindo on the pharma space. We don't have hospitals and the healthcare space. That is what we have. The earlier one you asked, I missed it. Sorry. The other one.
Insurance.
Insurance. Yes, so insurance, we genuinely looking at both SBI Life and HDFC Life. They are good defensives. They come out of those low growth phase. And now, of course, the growth is more from ULIPs. But I think they are now reasonable on valuation. We don't own in our AIF, but we own in our PMS. We're looking at it very positively to buy at the right price. One of them.
All right. That's the view coming in from Sanjay Parekh at Sohum Asset Managers.